If you have 2 million ounces of silver in your warehouse, you will sell 2 million on paper. If what you have in your warehouse goes up by $10 on your 2 million ounces, that's 20 million profit. Look at the Chinese. Price is getting its teeth kicked in. Gold's up about 60 bucks, 4,800, and big players calling, a lot of them, for $6,000 or higher by the end of the year. Could it happen? Sure, why not? Silver between $130 and $309 by the end of the year. That's $692 million worth of silver have been delivered so far in the first week or so. 2 million pounds of silver left. Billions of dollars worth left. Who's running logistics? Where are the trucks coming from? Who's doing that? Where's it going? Who's paying for it? War pushes up the price of oil, which pushes up the CPI, which pushes up inflation, which then makes no rate cuts. Well, that's bad for gold. Well, again, if people trusted the dollar and the treasury, it would be, but they don't. We knocked the price down to control the narrative and then stand for delivery because we don't use margin. They knocked off all the speculators, freaked everybody out. The largest silver deliveries in the history of recorded markets in China that month.
So when we had that big run up, a lot of people were well, I can't say a lot of people, but many people that I know were looking to sell and kind of liquidate. Silver's over $100. They were trying to sell, and there was a lot of the issues with the refineries and all of that, to where it was creating these huge backlogs and bottlenecks and such, to where people couldn't really get out of, couldn't really get liquid, and so. Do you see that as going to be, as prices continue to go higher, do you see that as going to be a consistent issue, or do you think there's things being worked on in the background to try to alleviate some of those issues?
Yeah, I think the jacking up of margin prices created issues that were maybe not intended. For example, the refiners don't just work with precious metals. They have integral part of the actual economy, and they all got shut down because of raising margin rates. I'll try to explain what I'm saying. If you're a company of our size that does a lot of business, typically you're going to hedge your exposure. Meaning if you have 2 million ounces of silver in your warehouse, you will sell 2 million on paper. If what you have in your warehouse goes up by $10 on your 2 million ounces, that's 20 million profit. It falls the exact same amount on what you sold short, and vice versa, so that you're never speculating with your inventory. You're market neutral. That's how you stay in business and don't screw yourself when the price falls by 30% like we saw in January.
The real stress point here is not silver demand, but the plumbing behind the market that most investors never see. As Andy Schectman points out here, a $10 move on 2 million ounces can create a $20 million offset that only works if the hedge system remains stable. When exchanges suddenly raise margin requirements, even firms that are market neutral can face a cash squeeze that has nothing to do with being wrong on price. That is where paper market rules can quietly distort physical market access for ordinary buyers. Next, Andy Schectman discusses why those hidden bottlenecks can become more dangerous as prices climb.
So in early December, let's say December 1st, I'm going to be close on these numbers, it would have cost us $15,000 approximately to hedge 5,000 ounces, one contract of silver. So we put that money in a margin account. Just sits there. It's a collateral account. Just sits there unless the price moves against us. So 5,000 ounces, call it at 60 bucks a piece back then, would have been $300,000 of silver I could control with $15,000 in my margin account. That's 5,000 ounces. We would typically have 2 million ounces in our warehouse, so you can see the cost is very high to hedge that. You got to have $20 million sitting in your margin account, right? Okay, fine. That's just silver. About gold and platinum. By the beginning of January, that number had gone up 300%. In terms of what you needed to have in your account. So 15,000 became over 50,000 to hedge 5,000 ounces. The cost of hedging your position became so high, the cost just became, it had to filter down into lower bid prices. And if you weren't hedging, a lot of the companies don't hedge, and the price fell by 30%, when you're lucky to make 2% in this industry, you're done, you're crushed. You're probably on life support right now if you've been able to hang on, because you lost so much in your inventory.
A 300% jump in hedging costs can break a business before the metal itself does. As Andy Schectman points out here, controlling $300,000 worth of silver once required about $15,000 in margin, then suddenly demanded more than $50,000 within weeks. That kind of shift forces dealers to lower bids, widen spreads, or stop taking inventory because survival becomes more important than competitiveness. Investors often blame premiums on greed, but sometimes those premiums are simply the visible cost of a market structure under strain. Next, Andy Schectman talks about how those rising costs spill directly into refinery operations.
So if you don't hedge, you better back your bid prices way back, because if not, and it goes against you, you are out of business. If you do hedge, your cost went up so much that the cost of doing business is such that you won't make any money unless you start to change things. Well, that spilled over into the refiners. If they have 50 million in inventory they paid for, and they're trying to break it down and turn it into shot and then melt it down and turn it into bars and rounds, that takes a period of time. You got to hedge that inventory. Well, they were getting margin called all through January as the price kept going higher and higher and higher. They had shorted the same amount that they had in inventory, which takes time to refine. So as their price of their inventory was going up, they're getting killed on their short position, and they were getting margin called. And then they kept raising rates on top of it, margin rates. The refiners are like, we can take no new business. We're going to go out of business. We're getting margin called. We're exposed. That's it. Well, the refiners are still months back ordered, and they're still hardly efficient right now. And it created a lot of problems. So I would like to hope that that will work itself out in the future. I've never seen bid prices like this ever, Daryl, in 36 years, ever. We're selling pre-65 junk silver right now at $2 back a spot. We're selling it. I've never, ever did that, ever in my career. It's a crazy, crazy, crazy time. Like to the IMF or the BIS's statement that this sell-off was largely structural, raising of margins and levered ETFs unwinding and rebalancing.
The market can look calm on a price chart while the supply chain underneath it is close to freezing. As Andy Schectman points out here, refiners holding $50 million in inventory were being margin called while processing metal they had already paid for. That means rising prices were creating cash stress instead of profit because paper hedges demanded immediate liquidity before physical products could be delivered. When refiners stop accepting new orders, investors are seeing a structural warning, not just a temporary delay in shipments. Next, Andy Schectman unravels why official explanations still fail to address that deeper imbalance.
The unintended consequences have been pretty profound. I think someone probably got chewed out for that, and I don't think you'll see that happen again. That would be my hope.
Yeah, for sure. Okay, so many of the big banks, the big institutions, they still have these high price targets on gold for year end and looking on out and such. So are you typically in agreement with that? Do you think we're going to get a period of consolidation? I mean, we went down to what, 4,300, 4,200. Now we're back at
4,100 at the bottom.
Yeah. Now we're at like what, 48, 49.
What are we at right now? Today, gold's up about $60, 4,800, and silver's up $4.50 to roughly 79. So, yeah, I do. I mean, you got all the big players calling, a lot of them, for $6,000 or higher by the end of the year. Could it happen? Sure, why not? Typically, you would expect to see things really take off come September, October. That's usually when you see things move. But look, the fundamentals would support it, certainly. Nothing has changed. If they're right about saying it was structural, not fundamental, nothing's changed. And all of these banks, Bank of America, you got the chief investment officer of Morgan Stanley, who earlier in the year said, sell half of your bonds, the 60-40 rule that's broken.
What stands out here is how institutional forecasts stay bullish even after violent corrections shake retail confidence. As Andy Schectman points out here, banks still discussing $6,000 gold are not changing their long-term view even after a sharp drop from recent highs. That creates a disconnect because public headlines focus on volatility, while larger firms keep positioning for the same macro trend underneath it. When major asset managers question the traditional 60-40 portfolio, that signals a deeper loss of trust in old defensive strategies. Next, Andy Schectman discusses why that institutional shift may matter more than daily price swings.
BlackRock just said the 60-40 rule is broken. The chief investment officer of Morgan Stanley said that 60% stock, 40% bond is broken. Sell half your bonds and buy metals. Well, BlackRock is doing the same thing. The lead analyst for Bank of America, Michael Hartnett, said no, you should have 25% of your wealth in precious metals. Their head gold trader just came out and said that he could see silver between $130 and $309 by the end of the year. So yeah, I mean, the banks are still calling for it. The logic, if you can separate the emotion, says, yeah, it should probably already be there based upon the demand and the dollar creation and the manipulation and all of the stuff. Sure, why not? But I don't focus on price, Daryl. I look at the fact that if you hold it long enough, the bull market will take care of your entry. The bull market will push this much higher.
Yeah.
Focusing on prices is dangerous, and I think you put yourself out on a limb, but I would say prices will go higher than people think possible.
Yeah. It just seems like a coiled spring right now. I mean, the markets too. I mean, because anytime there's some speculation on there's going to be a ceasefire or we're going to come to an agreement with Iran, like the markets just take off like, significantly.
The bigger signal here is not the metal forecast, but the fact that major institutions are abandoning the old portfolio playbook. As Andy Schectman points out here, firms like BlackRock and Morgan Stanley are openly questioning the traditional 60-40 allocation that guided investors for decades. When large banks begin shifting toward hard assets, it suggests concern about debt, currency stability, and bond market credibility that rarely gets explained on financial television. Retail investors often hear the target prices, but the deeper story is why institutions suddenly want protection. Next, Andy Schectman discusses what that change could mean for investors still relying on outdated strategies.
And it seems like there's a lot of energy being built up into the markets in general, but especially in gold and silver, that, if we do get some type of peace agreement or something like that, I could see this like really taking off.
Yeah, well, that's the silliness of the market, that it thinks in terms of minutes.
Yeah.
Look at the Chinese. Price is getting its teeth kicked in February and import more silver than the history of all of the records going in import-export numbers into China ever. That's the point. Price is a tool of misdirection, and the information that we are reacting to day by day, that's noise. Look at the big picture, the mathematics. The mathematics don't work out anymore for this country in terms of indebtedness and in terms of the trajectory. So I think that's the realization. System that isn't trusted, that is fiscally irresponsible, and is running out of mathematical runway. That's all these countries need to know, and look for every pullback that is engineered by the West stupidly as an opportunity to add to your stockpile at a subsidized rate. That's how they look at it. So yeah, I don't know what the end of the year will be, but go out a couple of years, and I think while this bull market still runs, prices will go way higher than people think possible. But that's not why you own it. You don't own it to get wealthy. You own it because it is wealth, and the most well-informed traders in the world are showing you that right now.
Well, I mean, one thing we know as far as sentiment, which I'm looking forward to seeing you in Boca at Rick's symposium. But for them to be sold out and no spots available, I mean, that says a lot.
They've been sold out for a while now, Daryl, like for a couple of weeks for sure, maybe a month or longer. So yeah, there's a lot. I've never seen that before that fast. So there's a lot of demand for this kind of information, a growing expansion of the hard asset community, but still represent but a very small speck of the mainstream of the whole pie.
Yeah.
Markets often react to headlines in minutes, while long-term capital quietly reacts to math that cannot be ignored. As Andy Schectman points out here, China increased silver imports during a price decline, showing that falling prices can attract stronger buyers instead of weaker conviction. That disconnect matters because retail investors are usually trained to follow sentiment, while sovereign buyers often accumulate during fear. When debt levels keep expanding faster than trust in government policy, physical ownership starts looking less speculative and more defensive. Next, Andy Schectman talks about why informed buyers may already be treating volatility as opportunity.
So I'm just curious in what are you seeing with retail behavior? I mean, because you all at Miles Franklin deal with a lot of people that want to protect their wealth and such. And so, what are you all seeing with retail
First of
behavior?
all, before I get there, that narrative again is just stupid. I mean, and that's what they want us to believe, right? And that rates are going higher, so that's bad for gold. Well, how about the fact that for 2-3 years after COVID, rates went higher faster than any time in history, from like 0 to 4+ in a period of like a year, and gold still went to the moon and tripled since then. Here we are since it was 0 in 2021 or whatever, to where we are now, from like 1,700 to almost 5,000 in rising rates. Convenient to ignore that by the mainstream when it's happening. And yeah, they want us to believe that, but if that were the truth, then why are we seeing record deliveries every single month? Why in the month of February did China import more silver than in the history of all recorded markets going into China ever? The month that it got destroyed. Why are we seeing these deliveries in every single month on COMEX? So far in April, 18,647 gold contracts at 100 ounces apiece. That's almost $1 billion. And 1,753 silver contracts at 5,000 ounces apiece. So let's do the math there.
One of the weakest narratives in finance is that higher rates automatically destroy gold demand. As Andy Schectman points out here, gold rose from roughly $1,700 to near $5,000, even while rates climbed at the fastest pace in decades. That should force analysts to explain why physical deliveries and overseas demand kept accelerating, while the standard textbook story kept failing. Instead, many commentators simply repeat old assumptions, because admitting the shift would challenge confidence in policy itself. Next, Andy Schectman unravels what the delivery numbers reveal about who may be taking metal off the market.
1,753 times 5,000 is 8,765,000 ounces, and let's multiply that times, silver's up almost $4 right now. It's at 79.20. So let's multiply that times 79. That's $692 million worth of silver have been delivered so far in the first week or so.
$1 billion?
Yeah.
Yeah.
692,435,000. Okay. But by the end of the month, because that's only for the first, what's the date today? It's for the first 2 weeks. By the end of the month, we'll be way over $1 billion. And it's been way over $1 billion every single month. In February, which is a non-delivery month, 25 million ounces delivered, 39 million ounces leave COMEX. Leave. 160% of what was delivered left. 2 million pounds of silver left. Billions of dollars worth left. Who's running logistics? Where are the trucks coming from? Who's doing that? Where's it going? Who's paying for it? 2 million ounces leave the eligible category a few Fridays ago. Those aren't even the bars that are available for sale because no one trusts the system anymore. The narrative that war pushes up the price of oil, which pushes up the CPI, which pushes up inflation, which then makes no rate cuts. Well, that's bad for gold. Well, again, if people trusted the dollar and the treasury, it would be, but they don't.
The delivery numbers matter more than the daily price, because movement often exposes conviction better than commentary. As Andy Schectman points out here, nearly $700 million in silver changed hands in just part of the month, with billions leaving exchange inventories repeatedly. When 160% of delivered silver exit the system, investors should ask why so much metal is being removed instead of rolled forward. That kind of withdrawal can signal declining trust in paper settlement even while headlines stay focused on inflation and rate speculation. Next, Andy Schectman discusses why trust itself may now be driving precious metals demand.
This is the MOPE, Management of Perception Economics, that my dear departed friend Jim Sinclair used to say. We knock the price down to control the narrative and then stand for delivery because we don't use margin. They knocked off all the speculators, freaked everybody out, and then you see every single month, even in the month of February when the price got hammered, huge deliveries here on COMEX and actually leaving the exchange, the largest silver deliveries in the history of recorded markets in China that month, And I'm telling you, the central banks haven't stopped, and nor have the deliveries on COMEX every month for 18 months. That betrays all of the mainstream narrative, which is still using.
They saw it as a bargain.
That's right. Let's shake them from the trees. We'll jack up the margin rates. Even the IMF came out and said, it was either the IMF or the BIS, that was not a fundamental decline. It was structural, largely blamed on rebalancing of levered ETFs and margin increases. They said it is not fundamental. It's structural. In other words, it was engineered. Jack margin rates up and rebalance the ETFs that were way out of whack because of silver's rise, and bang, create selling, beget selling, get margin call, I'm out. And it destroyed all of for the refining in this country. The refiners had to bail and say, we can take no new business. They were getting margin called every day.
Sometimes the sharpest market signal is not the price drop, but who quietly buys during the panic. As Andy Schectman points out here, silver kept leaving major exchanges for 18 straight months, even while public sentiment turned negative after margin-driven selling. That creates a serious disconnect because retail investors often interpret falling prices as weak demand, while institutional buyers can see forced liquidation as discounted excess. When even global agencies describe the decline as structural rather than fundamental, it raises uncomfortable questions about how market narratives are shaped. Next, Andy Schectman unravels who may have benefited most from that engineered pressure.
So the structural, engineered price decline fell right into the hands of the big traders. That would be the sovereign wealth funds, the governments, including the United States, in my opinion. All of these countries that want physical possession, that don't use margin, they said, thank you, we'll stand for delivery, bye-bye, at wickedly subsidized prices because of the leverage unwind, which, according to the highest, most powerful banks on the planet, was structural, not fundamental. So it's just a bunch of phooey that the mainstream media, which lacks any integrity or journalistic work effort or work ethic, they just sidestep.
The investors with the deepest pockets often profit when weaker hands are forced out first. As Andy Schectman points out here, sovereign funds and government-linked buyers can accumulate physical metal without relying on leverage, giving them an advantage during sharp paper-driven declines. That matters because ordinary investors usually hear about the sell-off long before they hear who stepped in to absorb supply at lower prices. When the media focuses only on volatility, it can hide the transfer of assets from emotional sellers to patient institutions.